A more complex strategy for managing your tax bill in a taxable account is called tax loss harvesting. And how does tax loss harvesting work? Now, when most people think about it, they think, okay, come December, I'm gonna look at my portfolio, I'm gonna sell the losers, I'm gonna sell some winners, I'm gonna offset those two, and I'm gonna call it a day. Proper tax loss harvesting isn't about locking in a loss. It's about swapping investments given market volatility for equivalent investments so you can take advantage of the losses, but you maintain your tax strategy. And professionally, tax loss harvesting is done throughout the entire year. It's not a one-time activity. It is a continuous monitoring of the portfolio, looking for those opportunities to sell and recognize the losses. Some of the tax loss harvesting strategies that professionals utilize are things like direct indexing, allowing you to take an index to break it up into its constituent pieces, and long short investing, allowing you to harvest losses both when the markets go up and when the markets go down. Now, what is the actual benefit of tax loss harvesting? It doesn't make your taxes go away, but what it does allow you to do is to control your tax bill. Essentially what you're doing is you're saying, I would have paid taxes for capital gains this year, but because I tax loss harvested, I'm not going to pay them this year. In fact, I'm going to borrow from the IRS without paying any interest, and I will decide when to pay that money back to the IRS. But in the meantime, I'm going to use my capital to grow my accounts faster.